A 40-year-old father bought a life insurance policy to protect his family. He didn't know it yet, but he just made a decision that quietly drains money from families just like his, year after year. Not because he bought too little coverage, not because he missed a payment, and not because he got scammed. He bought the policy most people think is the safer choice. And here's what that mistake costs the average family. About $6,000 a year, year after year. In just 12 years, that's roughly $72,000 in extra premiums. Gone. And that's before we talk about what that money could have become if it had been invested instead. Today, millions of Americans are making the exact same decision. And most of them have no idea what it's really costing them. Here's how a policy that feels responsible can quietly become one of the most expensive financial decisions a family ever makes. Over the next few minutes, I'll show you why two policies that promise the exact same protection can end up costing families hundreds of thousands of dollars apart. Why one option costs several times more than the other, and why so many responsible Americans still choose it. We'll also look at a simple strategy that turns those extra premiums into real family wealth instead. A difference that can grow into hundreds of thousands of dollars over a working lifetime. I'll show you the numbers shortly, but first, let's look at what happened to David. David is 38, office manager in Richmond, Virginia, makes $65,000 a year, married, 2 kids, ages 4 and 7. When his second child was born, he knew he needed life insurance. He went to an agent, a family friend. The agent recommended whole life insurance, $500,000 death benefit, $420 a month. The agent said it was an investment, that it builds cash value over time, that David would have money he could borrow against later. David signed. It felt responsible. What nobody told David is that a term life policy with the same death benefit would cost him about $40 a month. He is paying $380 more per month, $4,560 more per year, for a feature he does not need. That does not perform the way he was told. There are 2 main types of life insurance. Term life insurance. You pick a time period, usually 20 or 30 years. If you die during that time, your family gets the death benefit. If you survive the term, the policy ends, nothing paid out. It is simple and it is cheap. A healthy 35-year-old can get $500,000 in coverage for about $30 to $40 a month. Whole life insurance. It covers you for your entire life. No expiration. And it includes a savings component called cash value. A portion of your premium goes into this cash value account. Sounds like a bonus. Here is the problem. That cash value grows at roughly 1 to 3% per year. Most whole life policies guarantee about 2%. Meanwhile, a basic index fund has averaged roughly 7 to 10% per year over the last 40 years. And here is the part that shocks people. When you die, your family gets the death benefit, not the death benefit, plus the cash value. The cash value goes back to the insurance company. You spent decades paying higher premiums to build cash value. And when you die, the company keeps it. So why do insurance agents recommend whole life so often? Commission. On a term life policy, the agent earns a commission of roughly 30 to 50% of the first year's premium. On a $40 a month policy, that is about $144 to $240 total. On a whole life policy, the commission is roughly 50 to 100% of the first year's premium. on a $420 a month policy. That is $2,500 to $5,000. The agent earns 10 to 20 times more by selling you whole life. This is not illegal. This is not a scam. But it is a conflict of interest that nobody discloses at the kitchen table. The agent who recommended whole life to David, a family friend, earned roughly $3,000 from that sale. If he had recommended term instead, he would have earned about $200. But what about the cash value? Is it not worth something? Here is what actually happens. In the first 2 to 3 years of a whole life policy, your cash value is often zero or close to it. The early premiums go almost entirely to commissions and fees. By year 5, your cash value might be 10 to 15% of what you have paid in. By year 10, maybe 50 to 60%. It can take 15 to 20 years before your cash value equals what you have paid in premiums, and it is growing at 2%, while inflation is running above 3% in 2026. Your cash value is not growing. It is falling behind. And remember, if you die, that cash value does not go to your family. The insurance company keeps it. Your family only gets the death benefit, the same $500,000 they would have gotten from a term policy. To be fair, whole life insurance is not always wrong. It makes sense for a very specific group of people. If you have a large estate and need to cover estate taxes, so your heirs do not have to sell property or a business to pay the IRS. If you have a special needs child who will need lifelong financial support, and you need a guaranteed permanent death benefit. If you have maxed out every other tax-advantaged account, your 401k, your Roth IRA, your HSA, and you are looking for additional tax-deferred growth. For these situations, whole life is a legitimate tool. But for David, an office manager with 2 kids and a mortgage, he does not need lifetime coverage. He needs coverage until his kids are grown and his mortgage is paid off. That is a 20-year term, not a lifetime commitment at 10 times the cost. Now, the math I promised. David pays $420 a month for whole life. A term policy would cost him about $40. The difference is $380 a month. $4,560 a year. If David had bought term and invested that $380 a month in a total stock market index fund at 7% average return, after 10 years, he would have roughly $65,000. After 20 years, roughly $198,000. After 30 years, roughly $456,000. $456,000 in his own account that he controls, that his family inherits in full when he dies. His whole life cash value after 30 years, maybe $150,000 that the insurance company keeps when he dies. Buy term and invest the difference. $456,000 that his family keeps. Buy whole life. $150,000 that the insurance company keeps. Same monthly outflow. $300,000 difference. And David has been paying the wrong one for 4 years already. If you are sitting on a whole life policy right now, you might want to look at how much you are paying versus what term would cost. That gap is probably bigger than you think. David can fix this. Here is how. Step 1. Buy a 20-year term policy. At 38 with good health, roughly $45 to $55 a month. Takes about 30 minutes to apply online. Coverage starts within days. Step 2. Cancel the whole life policy after the term policy is active. Never cancel old coverage before new coverage is in place. When he cancels, he gets whatever cash value has accumulated, called the surrender value. After 4 years, that might be $2,000 to $4,000. Step 3. Invest the difference. Set up an automatic transfer of $370 a month to a Roth IRA or brokerage account, investing in a total market index fund. At 7% over 22 years until he is 60, that grows to approximately $240,000. 3 steps. Total time, about 2 hours. Potential result, $240,000 more by retirement. The insurance industry sells whole life as an investment. It is not an investment. It is insurance with a savings account attached that grows slower than inflation and goes back to the company when you die. Term life gives your family the same protection at 1/10 the cost. And the difference, if invested, builds real wealth in your account, under your control. For most working Americans, whole life insurance is not the right tool, but nobody told them. Because the person doing the recommending earns 10 times more if they say yes. What type of life insurance do you have right now? Tell me in the comments. Drop whole if you have whole life. Drop term if you have term. Drop none if you do not have any coverage yet. Or drop switching if this video changed your mind. If you are not sure what type you have, check your policy documents or call your insurer and ask. Describe your situation in the comments. I read everyone. My 1099 versus W2. Video shows the tax mistake millions make every April. And my capital gains video shows how to pay 0 in investment taxes. Both on your screen. Subscribe to Wealth Storyline. Every week we break down the money systems most Americans were never taught. See you there. This video is for educational and entertainment purposes only and should not be considered financial or insurance advice. Consult a licensed insurance professional for your specific situation.